Welcome back to another Antipodes Insights video, where today we'll be focusing on an update on the Antipodes China Fund. I'm joined by John Stavliotis, Portfolio Manager for the Antipodes China Fund. Welcome, John.
Thanks for having me.
So if we kick things off, John, let's sort of recap the last 12 months worth of performance, especially in light of us as a pragmatic value investor. How have we gone?
Yeah, so the China Fund returned 14.5% over the last year, which is, beat what you would have got from a global index or from Australian indices, as measured by MSCI Australia. What was interesting in China was you had excessive concentration of returns. So only 32.5% of stocks in the index beat the benchmark return. Wow. And that's actually the most concentrated level in the last 20 years. If you look at our positioning, we've kind of got, I guess, an exposure to some of these structural winners that benefited from these, capital flows into the country. And we've also got exposure to some of the more cyclical companies that are on extremely depressed valuations because of the weaker growth in the country. But importantly, they've shown resilience over the last 3 years, seeing stable earnings, strong distributions. And we think as the economy should recover, these stocks will give us a real outsized return to the portfolio. So given that positioning, we did underperform the bench over the last year, but we are seeing that returns broaden, and we have generated alpha in the last 6 months. And we believe that if we continue to see this outperformance of the market, we are positioned to benefit from both those structural winners and a recovery in the economy.
Now, in 2025, we saw one of the Chinese central government hallmark policies was this concept of the anti-involution trade, right? Effectively dealing with monopolies and whatnot. Can you sort of explain to the audience what that is all about? And then how do we try to exploit it through our portfolio holdings?
Yes, so anti-involution effectively is anti-excessive competition, right? It's basically supply-side reform is the best way to describe it. And that's not new in China. It happened in 2015. And what triggered it back then was you had about 45 consecutive months of negative PPI. Fast forward to last year, in June 2025, when this thematic started to make noise, we'd had 33 consecutive months of negative PPI. So similar sort of situation. Now, the difference between 2015, what happened then was you had the supply side reform, and then that was joined with demand side stimulus. And then that led to a huge bull market in Chinese equities. So far, we've had the supply side reform. We haven't really had effective demand side stimulus. And we're not really expecting huge demand side stimulus either. So how we've played this anti-involution, initially it led to a whole load of low quality companies, rallying because of an expectation that profitability will go up. But without the demand side stimulus, it's going to be hard for these companies to actually consistently perform. So the way we've, benefited from this anti-involution thematic is through a company called CATL. Now, we've looked for companies that on their own and through the period of excessive competition have generated strong returns. CATL has seen their ROE increase every period through that excessive competition period. Their market share has gone up. They've now got 40% market share in electric vehicle batteries globally and energy storage system batteries globally. Largest player in the world, even in light of the US trying to hold China out.
Yes.
So this company, with that growth, should actually see that accelerate now that the government is forcing the lower quality players to pull back their expenditures and excessive competition. CATL is growing at circa 23-25% in the next 3 years, and we're able to buy that at 19 times PE now. So we see that as a really good pragmatic value opportunity.
So John, another key structural theme that we've invested in the China Fund is regards to China's renewable energy changeover. Now, as we all know, and most people, broadly know, that China is now the largest producer and also the largest increase in deployment of new renewables into the economy. And China's not doing it only because it wants to achieve net zero, but it's actually cheaper than traditional forms of, energy sources. Now, we're playing this in the portfolio, both from a hardware and a software perspective. Can you sort of walk the audience through that?
Yeah, sure. So as you say, right, China is now has about 40% of their power generation coming from renewable sources of power. Now that as you say, that's helping reduce their cost of power production. And that's really important in the world now, right? Both from a manufacturing perspective, exports have been the key driver of GDP growth for China, and it maintains their competitiveness. And also, as you get more investment in AI data centers, power is the largest cost there, right? So that allows China to continue to invest in AI, even with probably with less powerful chips. Their power advantages gives them something to offset that disadvantage, I guess. Now, with all the renewables, you need to continue to build out the grid. China already has one of the most built-out grids in the world. They've been investing here for many decades, but as you add renewables, you need to continue to build this out. And this is one of the key ways that we've been investing to benefit from this renewables push that's happening in China. Now, the main investments we currently have or have had in the portfolio, supplies into the UHV line build-out. That's ultra high voltage line build-out, and that's XD and Pingao. Both those stocks have seen significant growth in their revenue, and we expect that to continue in the next 5 years. And they basically build primary equipment for the UHV line build-outs. We've also invested in C1, which supplies equipment into China, but also sells transformers and switchgear globally. Now, that's a really interesting market because the investment that's happening in the grid in the US, from a very low base, by the way, is basically sucking all the transformer supply, switchgear supply from the rest of the world. Okay. The Chinese companies generally are not selling directly into the US, but they're selling into the rest of the world and benefiting from that tightness. And C1 is seeing extremely high levels of growth in their export business. And we think that continues again for the foreseeable future, which makes these stocks a really interesting growth opportunities into this thematic.
So overall, we have generated strong returns within the Antipodes China Fund over and above global and also Australian equities. We are expecting to see a broadening out of those returns over time, given the concentration we saw in 2015. There are many themes that we are exposed to, including the anti-involution trade, as well as structural themes like the upgrade of the grid in China and the ongoing deployment of renewable energy. So there's always a lot happening in China. And as always, if you have any further questions, please reach out to your Antipodes representative or Pinnacle Investment Management.